Hello, everyone. A very warm evening to everyone who have joined us today for this webinar on an intriguing topic, accounting standards and internal audit. We have with our midst two excellent speakers who are partner of two large audit firms, Mr. Prasanna Venkatesh from Deloitte and Mr. Raghuram Kasiviswanathan from BSR and Co LLP. It is my pleasure to introduce them today. Mr. Prasanna Venkatesh is a chartered accountant and a BCom graduate with more than 18 years of experience, and he has worked extensively on statutory audit and other assurance engagements. He has made presentations in study circle meetings, events organized by SIRC and industry forums, and he has participated actively in other professional activities. Our next speaker for today is Mr. Raghuram. He has over 2 decades of professional experience spread across the industry and auditing. He has worked with various corporates, including Tata's and Henkel. Currently, he is a partner with BSR and Co, an affiliate of KPMG, and focuses on sectors including technology, automotive, FMCG, and NBFCs. He specializes, amongst others, in audit and international GAAP and US GAAP. He is a regular speaker and trainer on various technical topics, including financial management, Ind AS, IFRS, and US GAAP. He has conducted workshops for various corporates and CFO forums. He also forms part of FRRB review team of ICAI. With this brief introduction, with no further delay, I hand over the session to the speakers. Looking forward, sir. Thank you.
Thank you, Deepika. Good evening, everyone. It gives us great pleasure to be here and address all of you as part of this session today, accounting standards and internal audit. I think as you heard in the introduction, I think both me and Raghu are from the statutory audit background, and we naturally love talking about accounting standards and the technical side of the accounting standards. But given the topic here, what we will try and do during the next couple of hours is to, given the current context of the accounting standards and the broader gamut of financial reporting as it stands today in our country, how does that have an interplay with what the internal audit and the internal audit function does, and what we as professionals and internal auditors do, and how naturally both do complement, because the core of accounting standards and getting the financial reporting right is to have a very solid and a robust financial reporting ecosystem, which I think the core pillars would be a good risk assessment program and internal controls, which will be the core. And internal audit team and the function plays a very huge role in this overall process. And we will touch upon that. And what we will also do over the period as we go along is to touch upon a few specific topics, accounting areas, and look at what could be the possible focus areas and how each of those can be looked at from an internal audit perspective, an internal control view, and maybe share some of what we have seen as best practices in the sphere as such. So that's broadly how we will cover the next couple of hours, and of course at the end we will also have a session where if you have any questions, happy to address some of those as well. Okay, where we are today in terms of the accounting and auditing landscape as it stands now, the regulatory expectations from a accounting and an auditing angle has been on a rise to the extent that it has resulted in multiple reporting requirements. Expectations from each regulators also tend to vary, and that's something which we as professionals will have to deal with. The businesses are getting complex by the day, be it not just in terms of one important element of how the businesses have grown, how the landscape have moved is the element of technology. I don't think any of us can deny that. I think that impacts every walk of our lives. What has also happened with the advent of technology, with the advent of the startup ecosystem, the entire supplier ecosystem, the way it has evolved over a period with say the globalization, etc. The way the business arrangements gets executed have also become complex, and that it by itself poses its own challenges on how the financial reporting element comes into play. Accounting standards and the reporting requirements have evolved as well. I mentioned about the ecosystem having got evolved from a business environment perspective. Combine that with the way the accounting standards have evolved, be it the Indian equivalent of IFRS, which is the Ind AS, the fair value basis of accounting, some of the accounting concepts that have come in the element of, say, the concept of control. Certain examples as which we encounter on a day-to-day basis nowadays is a company enters into a technical collaboration agreement with a startup with a bare minimum 5% equity interest. Given the requirements from an accounting standard perspective, it is imperative for the company to then also evaluate what does that arrangement entail. It's just not a mere 5% stake. It's just not a mere collaboration agreement. Is there a joint arrangement? Is there a control involved in it? Is there a significant influence involved in it? And each of this then poses its challenges of how does accounting take place? Is there a requirement to consolidate those entities? Now, as companies enter into transactions, given some of the way the businesses is getting evolved and the accounting standards are emerging, it poses its own areas of judgments and estimates, which the professional community have to really be on top of in the way they actually implement some of those things. And that's really the way things are actually moving. And we will touch upon few areas of those estimates and how things are being looked at from a control angle, from getting those estimates and judgment areas robust and right. I think that's a very, very important element. With all these that's happening, it then also poses its own challenge and the relevance of getting our records right, the company's records right and straight is of paramount importance today. I think we talk about with so much of applications that's being spread out, and what's also happening, we spoke about the expected enhanced regulatory expectations. Now the regulators with the technology, the regulators are also talking amongst themselves. It's very, very important that the company's systems are accurate. The company's systems shows there is one truth in the overall the records that comes out of a particular entity, and that it has always been important. And in the current age and times, I think the importance of accurate data and maintenance of proper records is the core. Now, touching upon all of this, and to get then the entire output from a financial reporting angle and an accounting angle right, the focus naturally then moves to what is the entire governance ecosystem that's there in an entity. What is the risk management mechanism that the company has, and the controls that the entity has to address those risks that the particular industry or the particular business warrants. Internal audit as a function, and internal audit as a professional community is a very, very important stakeholder in this entire enterprise risk management ecosystem, and therefore the focus that the internal audit professionals give to some of these areas and what comes out of that goes a long way in actually enhancing the entire say the ecosystem in terms of the risk control matrices, the controls itself, how these have been evolving. I think that's really where the link comes in terms of how the outcome from an internal audit mechanism really plays a way in making the internal control mechanism more robust and contribute in that process. So that's something which is very relevant in the days and times that we are currently living at. If anything that's say from a financial reporting perspective, the core is getting the risk assessment right and the controls right that addresses those risks. And the way any audit typically goes and any entity does its business is to see, okay, what are all the risks that a particular business entail. Now, at a business level, at a particular account balance level, when it comes to financial reporting, what are the controls and mechanisms that the company has in place to address those risks? And then make sure that how these get tested and evaluated in the context of the overall financial reporting. Now, when we talk about risk assessment, it's a end-to-end process. It just covers the overall the IT ecosystem, the entire supplier and the customer ecosystem that the company has, the controls, checks and balances in terms of fraud prevention, fraud detection mechanisms that the entity has, and does the company have the right people to do it? Enough processes and checks and balances built in, and do they have enough tools and techniques in the overall context to achieve this the end objective? And here again, the role of what an internal audit team does and the outcome from the internal audit exercise plays a huge role in terms of identifying the right areas of risks, including addressing how the controls have been operating and things have been shaping up in terms of the financial reporting mechanisms itself. So the way we will also touch upon some of the topics as we move along is to, okay, if the requirement from an accounting angle is X, what are all the possible risks of what could go wrong in that particular area, and what are the perceived risks, and what are those typical activities or controls that one would expect to see in each of these entities, and practically how does it work out when we look at it in an organization perspective is something which we will dwell upon for specific areas as we move along. In terms of getting the risk assessment right itself, I think an important ingredient, as I mentioned, is the way the internal audit function goes and how the stakeholders look at it, what type of observations, etc., that comes. Elements that we do consider in the overall context is how a particular account balance or a particular area of accounting, is it something which is subject to a lot of estimates? Is it something which is a material item? Have there been past history of errors or control deficiencies or even internal control observations in a particular area? Say, for example, a supplier master maintenance as an observation, purchase order control as an observation. I think if there are multiple repeat observations that are coming in some of those areas, that then is an area which will be important, given it is material and it's a area which is having its own judgment, and then move on to areas like complexity of that particular item, the related party, existence of related party transactions. And that's really then we drill down to say, okay, we have multiple account balances in an entity, be it revenue, be it a fixed asset balance, be it a intangible asset balance. What does that balance comprise of? Is that subject to enough a lot of estimates? Is that a material balance? Have there been issues in that particular balance in the past? Is it an area of complex nature? And then we drill down to see, okay, what then are the steps that one would need to perform in terms of ensuring that the company has enough controls that are built in to ensure the issues in that particular area is getting addressed, and focus on what that improvement has to be in those particular areas. So to that extent, from a risk assessment perspective, it's important we factor in some of these elements, as simple as just also say we take an example of a bank reconciliation statement. It's important we understand how a particular process actually works. Now, what does a reconciliation entail? Now, in today's world, where it's say gone are the days where companies used to have say hundreds of checks which gets issued and things lying unreconciled over a period. So what constitutes a valid reconciling item itself is something which is very, very relevant for someone to understand as you assess the risk and move forward to get, okay, is my bank balance reflecting the correct number? Combined with that is then also looking at who then performs that bank reconciliation. Is there a process to review that bank reconciliation that's there in that company? What comes as inputs? Now, yes, we do get a bank statement. Is that something which is a reliable input for us to consider? Now, you go.
I think Prasanna, we lost you.
Yeah, I'm sorry, Raghu. I'm back. Audible now?
Yeah, you're audible now. I think in between when you're talking, 2 minutes back, you lost you. Yeah, if you want to just.
Yeah, sure. Okay. I was on the topic of bank reconciliations. That's something which that's where I got lost, Raghu.
Maybe slightly after that, in terms of when you're just talking about the time in terms of focus.
Yeah. Okay, I think the screen should be up now. Yeah. Okay, so I think I was on basically giving the example of how something which appears quite straightforward in the context of a bank reconciliation statement. Now, elements like who performs, what entails a reconciling item, the frequency with which it gets actually done, and if there are reconciling items, is that something which is valid to be there, and how this entire sequence then results in a conclusion that what is getting presented in the financial statements as a cash and bank balance is appropriately stated. It then entails a sequence of events which then has to go through its own rigor in terms of a preparation activity, in terms of a review activity, in the form of a control that the company has in place, and then an ultimate conclusion to say whether that's being something which is correctly reflected in the overall scheme of things. And this is just a simple example, but what then also means when we go about doing our, say, an internal audit of an entity, say a control testing, a management testing for controls in a particular entity, we look at some of these elements for each of these areas to say, okay, are these things designed, and is it actually operating the way it was meant to be operating, and can there be items which can be improved in these areas for the entire financial reporting objective at the end of the day to be met? I think that's something which is in the overall context very relevant as we look at the financial reporting element within the ambit of internal audit itself. Some of the core mechanisms or the core areas which have always been important and have been emphasized upon over a period, be it the SOD checks that the companies have, the controls in the form of reconciliations, the physical controls to ensure existence. While we all live in the age of technology, I think nothing like going and seeing whether some things exist and how robust that particular mechanism actually takes place. Given the advent of technology, the entire gamut of IT general controls, some of these core elements are fundamental and will be very relevant in what we are also going to talk in the specific areas that we will get into as well. Now, with this background, what we will do over the course of say the next hour or so is to just dwell upon a few specific accounting areas and accounting standards, which will then relay the context in terms of how the controls and the steps that an internal audit activity does could play a role in getting the overall financial reporting and accounting standard compliance right. Before we start with say a specific accounting standard or an area, maybe Raghu, I just wanted to request you to give up your thoughts and context in terms of the topic as such.
Sure. Thanks, Prasanna. Okay. So just to thanks for the invite. Really happy to be a part of this session. Just to step back and then see for a minute, the entire internal audit function has evolved very differently over the past few decades. Earlier, whenever we relate to the word internal audit or internal audit function, it was more a transactional audit. And later, things evolved in such a way that internal audit team was slowly made responsible for process. Internal audit was made responsible for looking at cost efficiency, and slowly it crept into various other places as well. Now, therefore, the focus of the function has also now widened quite ahead and very different to not only focusing on the financial reporting. And therefore, each company may have their own set of, I would say, priority in terms of what an internal audit function should be looking at. There are places where the focus is mainly on cost management. There are focus mainly on processes, focus on business-related aspects. There are some MNCs which only focus on either a SOX reporting, or there could be various situations where people focus on ICOFR as a topic because it's mandatory. So the function of an internal audit itself has spread quite well. And what has happened in that process is that some of these topics, like focusing in terms of looking at any impact which could come from an accounting standard perspective, sometimes gets missed out. And I thought that is the reason why this session was put into place, to perhaps put some thoughts surrounding that. And what we will also do is that we'll pick up topics like revenue, etc. Prasanna will take through or revenues, etc. But the other topics which we have chosen are really like one-off topics. When we mean one-off topics, not necessarily those topics which will come on a routine basis, but topics which are of great interest currently in the current scheme of things. For example, how does an internal control function look through a business combination? How does it look through in case of provisioning? How does one needs to look at in case of an impairment, lease accounting, etc. And how an internal audit function can really play a very great role. Currently, the audit committees and boards are very, very keen to understand this in far more detail, and they have an onerous responsibility now to ensure that all of these functions in a better and efficient way. Given that responsibility on the board, the internal audit function, either in-house or otherwise, is really very critical in the entire scheme of things to ensure that they give the adequate comfort in terms of looking at the processes and commenting, and therefore that becomes really very important. So what we will do is that we will of course spend the next 1 hour or so to take you through on those topics, and we will leave a good amount of 30 minutes towards the end for more question and answers. We'll be really happy to have a good interaction with the entire team and discuss on some of the topics which may come across. So with this, I'll hand it back to Prasanna to first take on the first topic, and then we can start going there.
I think, as we mentioned, we'll go with some of these topics that we thought would be relevant to cover from a revenue recognition angle. The way we have also possibly structured this is to say, okay, fine, if the typical risk that is associated with a particular account balance is what it is stated. Now, what are the typical controls that the company has in place, and where what could be the areas of focus when we look at it? Now, just to very quickly set a context in terms of how the accounting standard itself has evolved over the last, say, particularly with the advent of Ind AS, it has brought in elements like say concept of control and transfer of control. In the earlier days, it used to be risks and rewards in terms of the overall transaction. Now it brings in a concept of control. It talks about what constitutes a contract, what conditions should be met for it to meet the definition of a particular say contract to be covered under that particular standard. Brings in a concept of what is a performance obligation. Now I enter into a contract with a customer. Am I only providing a product? Am I also providing a product together with a service? Are these to be looked at together? Are these to be looked at as two standalone or separate performance obligations? And in such situations, it also then provides guidance in terms of how the price of that particular contract or transaction have to be split in terms of recognizing the revenue. What is the method to recognize the revenue for each of these performance obligations that the company has in a particular contract? Provides detailed guidances on principal, agent in these situations, and also finally a standard which extensively gives requirements for a company to disclose its revenue, right from disaggregating by nature, including significant judgments that the company has exercised in a particular revenue recognition angle. Now, the typical risks as far as revenue is concerned is the same. It has not changed much in terms of is the revenue recorded at the right amount? Is the revenue complete? Is it accounted in the right period? Is it actually reflecting for all the transactions that have actually occurred? That's really what the risks entail. Now, given these requirements of the standards, what then has now become very important is to get some of these focus surrounding the controls, how a company maintains a contract database. Do they even have in the first place a contract master to say, okay, these are all the contracts that a particular company has? Now, it becomes, depending on the industry in which a particular company operates, each of this could have its own elements, but then getting that listing of a contract is a core, and that's something which has gained enough importance as things have evolved, including an assessment of how the criteria for what a contract constitutes gets met. The importance of a customer master file is something which is very, very relevant. And when we talk about customer master file, one is to get the initial input into a particular customer right, particular contract also right, given a particular customer. Okay, what are all the various obligations that the company owes to that customer? What is the term of a contract that has been entered into as far as a particular customer is concerned? What is the credit period that gets paid? Are there elements of extended credit period that gets provided to a particular customer? Now, these are very important elements that needs to be captured as part of the contract database and as part of the customer master in the ERP or an IT application for an entity, because with the volume that we are talking about, unless some of the controls related to these and the way the data gets captured in this is robust, it's going to pose its own challenges in the context of recognizing the revenue and ensuring that the requirements from a reporting angle is getting met as well. So now that's something which, and when we talk about, say, review of the things like review of customer master file, review of a GST master, for example, and reconciliation with GST returns, it becomes quite complicated in the, say, as for entities who have contracts spread across years. The timing of how it gets reflected in the GST returns is one, how it comes in the financial statement angle is different. Now, each of those warrants a thought process and a control to be put in place to ensure that those reconciliations is getting met and getting captured correctly. So what we have listed here and a few areas in terms of what gets captured, those which are relevant for an audit activity to specifically look at, take a particular contract and see how these are actually getting captured. Is it reflecting the right facts that are there in the contract? Is it then getting computed appropriately in terms of the ultimate financial statement presentation? Whatever be the number that's getting allocated to a particular consideration, is it getting appropriately provided and captured? And that's something which is very relevant in the overall context of revenue recognition as an area. Now, as a topic, I think revenue has been an important topic in any entity. I think it's something which is where there is a presumed fraud risk that any accounting standard you take, that's really what it talks about, and therefore it's also something which has gained paramount importance in the context of how the control environment related to a particular revenue area gets configured, depending upon whether the correct revenue is getting recognized and how those gets actually gets addressed as well. Now, in that context, I touched upon what the standard itself entails. One important element when it comes to the revenue recognition is an analysis of the standard, a particular contract, to see how this particular contract fits within the entire accounting framework. And very typically, what we also see in many entities is a case where there is a team which prepares. A large contract has been entered into, a team which sits and prepares a particular accounting entries, accounting analysis, and comes up with the revenue recognition scheme as far as that entity is concerned. But what very often gets missed is the fact that how much of that is being reviewed by a right person with enough knowledge and experience to really challenge and say, okay, if a particular contract is spread across 2 years, has its own elements in terms of 3 performance obligations. Each performance obligations, be it for a product I render, I then install, I have a service that get provided over a period of 2 years. I also provide a free maintenance and on-call warranty over a period of 3 years. How each of these elements then has to be accounted. Now, this requires an element of knowledge with experience, understanding of the business, and that it's that control activity that's becoming very, very robust and important in the context of applying some of these standards. And it's important that when we look at any of these complex areas, we look for whether that particular activity itself is present. Is it being done by the right person? Whatever that person does, is it following a particular sequence? It's described in enough detail for anybody to come to a conclusion that it's something which is actually achieving the right result in terms of the revenue recognition. That's something which is important. So the distinction to what a person does to prepare a particular accounting memo vis-a-vis the mechanism to check that, review that, and challenge and then say, okay, this is what the accounting standard says, this is what the contract says, this is how I will apply that particular standard. And document all of that in the memo is a very, very important and relevant control that one should look out for, particularly in the context of a standard such as this. As we go through a particular a control activity that someone does, I think there are 2-3 elements that becomes very, very important and for us to look at. And we spoke about a contract database, for example. Now, for any activity to be done, what are those relevant inputs that one has to consider? Now, say I get a report of my entire invoices generated in a particular period. I get a report of all my contracts over a particular period. First, identifying those inputs, and also then making sure, is that something which is getting tested and is it relevant in the overall context? Is it giving us the right amount and what activities a particular control the activity owner performs to ensure that the using that input, whatever be the computations that gets made is something which is relevant in the context of accounting standard. Is it being checked for whether it's accurate? Is it being checked for the completeness? Now, these are activities which we would need to look out for very specifically in enough detail for each of the steps that we go through so that the ultimate outcome is actually getting met. Because invariably what also happens is the company keeps saying, yes, we have a control. Now there is a person who has reviewed. I think you go to your finance controller, the finance controller will always give an answer, yes, I have reviewed it, the accounting is fine. But what one reviewed and what are those activities that went through in this entire review process? Was there all elements that were looked at? Was there the key terms in the contract that were evaluated? The key requirements in an accounting standard that were evaluated? Is that getting described and captured enough? Is something which one needs to look at very, very extensive detail as we look at some of these particular areas. Now, some of these are basically examples in terms of what a particular input a reviewer for a sales report actually uses. A typical example in the case of a product scenario would be a gross sales report. Say, assume an example of an allowance that a company creates for sales return. Now, as per the accounting framework and the standard, if there is going to be a pattern of sales return, you'll have to estimate and then create an allowance for how much is the expected sales return. Now, these are the typical inputs that a particular reviewer then takes. Now, then what is important is, as part of the activity, to understand, okay, what does that reviewer actually do? One is to get a report and say, okay, I did some Excel computations and it gives me an output. But then also it's important for that particular methodology. A company comes with a conclusion to say, my sales return reserve at every quarter end or at every year end is 3% of my sales. 3% of my sales I will reverse, and this is the expected sales return. Now that then has to have a methodology that then has to be backed up with adequate past analysis of how the trend has been in the past, whether the trend, whatever was decided, continues to hold good as we move ahead in terms of the periods. What often also happens practically is, say, this particular percentage would have got decided 2 years back. Company meticulously follows that year on year, quarter on quarter, and you go 3 years down the line, it still continues to be 3.5%. But then the business models have evolved now. I think the business practices have evolved, and for all you know, we end up in situations where the actual trend on the actual percentage today is maybe 1%, not even 1%, and that then poses its own issue in terms of how robust the particular methodology is, and does it continue to be robust, and how often that gets validated. And each of these activities has to be done in a very, very specific and methodic manner, so that the conclusion that one derives out of this is something which very clearly gets documented as well, because it then goes on to as an output, whoever be the person in charge of revenue is in a position to then come to a conclusion that I have looked at the past data, I have looked at the current trend, I have looked at the methodology that one gets to use in an area such as say sales return allowance. Having seen all of this, having got a comfort over the completeness and accuracy of a particular report that I have used, I come to the conclusion that this is something which is making sense, and then eventually it gets signed off. Now, as part of the audit activity, what is also important is to look out for those aspects to see, okay, if there is a control that has been designed, and if there are people who are actually exercising or carrying out those control activities, are they doing it at that level of precision? and that level of documentation, which is enough to ensure that the ultimate financial reporting objectives get met. And it's an internal audit team, as they go out and do some of these tests, could play a huge role in terms of looking at some of these things, because that then helps in the overall context of achieving the right amount of revenue gets recorded as well as disclosed in the overall scheme of things. Now, this was one example of revenue that we saw, which is something which gets done on a day-to-day basis. As Raghu mentioned, there are few areas which I'll request Raghu to cover, which are more in the say domain of judgment and estimates, and some, I think Raghu will touch upon those and what are those elements that we can look at specifically. Over to you, Raghu.
Prasanna. Okay. Over the next 30 minutes, we'll go through a few other topics which are more one-off, I would say, meaning they are not recurring like a revenue or a cost which one would typically see. They are all typically forming part of the FSCP process, as one essentially calls, which essentially is the close process, which comes through either in a quarter or a yearly end. So the first topic is on expected credit loss. So in the past, you would be aware that in case of a manufacturing company or service organization, typically provision is made on, say, a simple asset base called a debtor, or as a provision for doubtful debts, and there used to be a policy wherein the company, based on past historical trend, either has a bucketing provision, as they call, or do a provisioning based on specific methodology. Now, and given that Ind AS came in picture during 1718, the concept of ECL has come in through IFRS 9, which is Ind AS 109 here, and what essentially this is to replace the incurred loss model is essentially to look beyond what was history and also to see how the future creditworthiness of the respective customers would be. So I'll just take an example of a customer base and then talk through on this ECL concept. One initially for a manufacturing company, then we can also spend some time to look and see how this impacts banks, NBFCs, and so on. And given that mutual funds are going to be in Ind AS from the next coming year, this plays a very important role in many of the clients in the FS space as well. So when one looks at this area, what essentially are the key inputs is essentially one has to first, for example, if you have to take trade receivable as a very classic case, one needs to extract the data points with respect to aging. And then one needs to look at what is the essential assumptions the company has used to ensure that the aging report from the system is accurate, the way the reports are taken care of is properly, the IT control surrounding that is one aspect of control testing, which typically one looks upon from an audit perspective. And also the other area which one looks upon is with respect to the historical trend, and also have discussions with the business to understand whether the management's assessment of how provisioning is made is relevant. Now, given that a new onset of ECL has come through, one has to not only look at the simplistic base of aging, but has to see whether all of these assets would fit into either a 12-month model or a lifetime model on these financial instruments, and possibly stage it out. So typically the way, for example, financial service industry would behave in this is stage it between a 1, 2, or a 3, which essentially a par 30, 60, and 90. And there would be data points which one needs to essentially capture, which is voluminous, right? So there are various concepts which the standard talks about in terms of the impact which the provisioning will have on, for example, what would be the probability of default, which the entire book would hold on, what will be the loss given default, as they call LGD, which will come through, and all of this is applied on the EAD, which is the exposure at default, which is essentially the entire book in one sense. So from an internal audit view standpoint, one has to essentially first as a focus look at first what is the policy which the audit committee and board has really approved from a risk committee perspective in terms of how the entire ECL would behave, and also look at three key aspects. The first aspect I would call as data integrity, and the second aspect I would call as the calculation model, the model which is used for computing the entire ECL. And the third is a broader aspect with respect to credit quality assessment. So let's go one by one in terms of looking at it. Data integrity is very important because in many situations, the data is extremely voluminous, and there are both historical data, there are current data, and also forward-looking information available in this. And therefore, if management is extracting some of these information as an internal audit function, one has to be very clear in terms of ensuring that these data is complete, and there is a proper approved methodology which has been used to ensure that all the calculations used are appropriate and also independently reviewed. The next input, which essentially comes onto the base data on matters surrounding probability of default and loss given default. Many of these factors would not only be restricted to the company, but also would be available in a public database, or in also on some of the Basel reports, or it could also be based on an industry pattern, a trend in a particular business segment line of the company, etc. And therefore, one has to really challenge the management in terms of how these are being looked at, because now currently this challenge process is very, very critical, I would say, from an internal audit function, because management would have their own bias in terms of that ability to collect and the confidence to collect some of these parties and some of these assets. And therefore, one has to really be objective in looking at independently in terms of whether the assumption which has gone to, in terms of determining what could be the possible LGD and the PDs are appropriate. In many of the situations, there could be cases where managements do adjustments for one-off events. For example, we were well aware that COVID really hit us hard in the last 2 years, and therefore some of these models have really been tweaked to ensure that some of the impacts are not directly correlatable to COVID, and there could be a possible improvement in the book. And therefore, judgment and estimates are involved in terms of assessing what's a reasonable estimate of such provisioning in that situation. And now currently we are facing with a lot of global crisis, and we are possibly looking at some recessions, etc. And therefore, if this is going to have an impact on the future book of a company, how does one really take into effect all of this and ensure that the assumptions taken by the company and the supportings thereon are really reviewed at? So that is something which can be a good challenging session which the internal audit function can have with the management to ensure that the messages is passed accurately. Some of these can also be worked upon independently. There are a lot of databases available which would essentially show a trend in terms of how a PD behaves in particular case, and also an LGD will look for a particular stream of company. The third important bucket is with respect to a credit quality assessment. What I mean by a credit quality assessment is looking at a credit monitoring level of each customer. There are various bases and methodology which is now available, including CIBIL score, rating agencies, which really go ahead and predict what is the creditworthiness of a particular customer. And therefore, these can be good benchmarks for a company to start with to assess the credit quality of the customer when there are possibly a BTB book or where there are large amount of DOs and underwritings therefore. So some of these factors can also be taken into consideration on a case-to-case basis, where it is a large size ticket in terms of loan book and not necessarily retail book. In a retail book, typically one looks at parameters in terms of dissecting the entire book in terms of either a state-wise analysis, or they may do a product-wise analysis, or they may even do a customer-based analysis. So the IA function, I would say, is very close to business, and they understand the business far better. And therefore, there should be a good amount of challenge on the estimate the company is making in terms of the sectoral cut, and therefore trying to ensure that what sectoral cut the company is doing for arriving at the credit parameter is in line with the credit model and the risk of the company. So I would also add on one more point in the entire ECL is with respect to an evaluation of this on a periodic basis. Sometimes the model throws a very odd number, which we all have seen in the past in terms of our own experience and history, etc. And therefore, the management has an overlay and estimates to it. So this overlay is very, very judgmental, and therefore many audit committees and boards are really looking through to seek some comfort independently, and the IIA function there can really step in and say that we have looked at the estimates, we have looked at the overlays and had discussions with the business teams, and therefore look at what are those assumptions the company is doing, and then see whether the credit monitoring mechanisms the management has put in place are appropriate, and therefore the basis in which the past due loans are being looked upon are accurate, and give that comfort to the board and the management after doing the due process. So these controls are therefore, while I say it needs to be looked upon through an estimate process, needs to also be translated into what are the risks that therefore a company should be facing, what could go wrongs in the company, and what are the risk and control mitigation factors. While mitigating factors can be a review process and mechanisms, what could go wrong is very, very critical to identify, and whatever we discussed in terms of data integrity which could go wrong, a computation in the model which could go wrong, assessment of a PD LG which could go wrong, and a credit monitoring mechanism could go wrong, could all be the factors which one could actually go wrong in the entire computation of an ECL, and one has to map what controls the company has got and put in place, and then therefore look at the processes relating to that. I will move on to another topic now, which is also one-off topic in terms of from an accounting standard perspective, which possibly the management is very clued on, which a statutory auditor, for example, is very clued on, where internal audit can also play a fantastic and bigger role, which is the business combination. Before even getting into the areas of focus, many successful integrations has happened in situations where companies have actually used the internal audit function well ahead of time in terms of understanding the controls and processes of the companies which they have acquired, which is the acquiree. The reason why I say that is that while accounting is one part of it, which we'll come to in terms of discussing the accounting implications and controls surrounding that, but process integration is very, very important. And the internal audit function is one team which has very good understanding of the process of the existing company. And therefore, their assessment independently of the processes of the acquiree is very critical, and therefore one can easily map the controls which the company has got and the controls which the acquiree has got. So the alignment between acquirer and acquiree can be done very well seamlessly by the internal audit function. And the reason I say that is that beyond of a business combination accounting, there's a lot of things to as a role play by the internal audit team in terms of looking at synergies between the two things and getting into one single control framework, because that is the key important and expectation of any company, and this mapping could really help the company in one way or the other. But getting back to this topic itself, in terms of accounting for business combination and what all controls one could look through, yes, is multiple. So just give a context of business combination. Once a company is acquired, there are 2-3 things which typically happen. There is a consideration which gets paid out, and in lieu of the consideration, the company gets assets and liabilities on the books, and these assets and liabilities are fair value. So when I say fair value, there could be assets representing cash, current assets, which could equate to a book value assessment, but there could also in the way be a lot of intangibles and other assets which could be identified, and they could also come on the books, and the resulting amount sits as goodwill. So in this, when one looks at what are all the processes and risk one should really look at, first thing is critical thing is in terms of completeness of all the transactions. So first, what is the transaction all about, and the complete list of assets and liabilities to be taken over is one critical steps which many management really sometimes slip it out, and therefore a very integral part of the function and the risk control assessment is to ensure that a completeness check is done and there is a proper control in place to ensure that all the assets and liabilities of the acquiree is taken into the books of the acquirer. Now, even before getting into it, the assessment which the company has to make in this case is to consider at what point in time the control gets transferred, and one needs to look at it in terms of assessing whether the management's assessment in terms of getting to a conclusion on the time the control is getting transferred is meaningful and right, because this date is critical in the context of determining the acquisition date, as they call, and therefore all the accounting happens on that date. Now, after having defined that date and look under the key terms and contracts looked upon in terms of completeness, the most critical item which comes to is fair valuation of some of the intangibles. For example, let us take a case of an intangible of a customer contract or a customer relationship, or it could be a non-compete agreement, non-compete clause, etc. So in these situations, there are various underlyings which go into assumptions. For example, future business projections, cash flow monitoring mechanisms, etc., where there has to be a good control the company has to put in play to ensure that all the future projections taken, either in terms of cash flows or in terms of contracts or in terms of business relationships, are adequate, it makes sense, and they can stack up in terms of numbers. So the control which the company has to put in place is to ensure that they are appropriate, and the internal audit function nearly needs to go back, challenge the company, and see how these assessments are done, what assumptions are being put across in terms of identifying these. First, the intangibles, whether they really stack up to intangible as per the definition of the standard, and number two, if they qualify for intangible definition, how do you measure them? And this measurement is essentially a stacking up of all these data points. The other key assumption which is essentially used in the entire process is what we call a WACC rate, a weighted average cost of capital, which essentially is a rate used to define a time value of money, and discounting are done. So one has to really challenge and look at just such key assumptions in terms of whether the company is using an appropriate rate, what control mechanism it has got to arrive at that rate, have they spoken to the banker to get at the lending rate, have they got what is their internal cost of capital rate, and how do they blend and come across with a composite WACC rate. The once this is done, and at least the company is able to get to a proper assessment in terms of the intangibles, then the next question comes, which is very critical, is in terms of looking for the contract, if there are any contingent consideration, if there are any deferred consideration, because these also from an accounting perspective has very different implications. For example, a contingent consideration need to get accounted for on day one. Some contingent consideration may not get accounted for on day one. So one has to look through the lens of standards to ensure that an accounting on day one is done appropriately. There could be situations where consideration is not paid fully on day one. They are paid over a manner of time. Maybe something is paid in year one, few amount would be paid in year two or year three thereafter. And therefore, discounting of that deferred consideration is also very critical and key to bring back and show the consideration at the rightful way. There could also be situations where the deferred consideration is based upon achievement of some of the parameters, like for example, revenues, EBITDA of the new company. Now, this is where as internal auditors, one needs to really look upon and challenge the management in terms of how did they come to a conclusion that over the next 2-3 years, the acquiree would be able to achieve the EBITDA, would be able to achieve the revenue targets. Because if they're confident that they would be coming through, then they may need to be set up on day one. If not, they may have to be deferred in one manner or the other and accounted for later. and accounted for later has a lot of serious repercussions for the company, because some of that goes through the income statement as well. So the day one accounting becomes very critical and challenging, and therefore a lot of risks are envisaged by the company, and the company really needs to have a good control process to ensure that all of this is tightened and they are in compliance with the standards. Once all of this is done from an accounting perspective, the most critical thing is the first thing which I also alluded upon is the post-business combination activity. In terms of integrating the systems, in terms of integrating the business process, in terms of integrating the IT applications, for example, and there the company needs to come up essentially with a roadmap and work very closely with the, I would say, the internal function as well, so that those can be implemented very seamlessly and can be transitioned upon and checked upon on a concurrent basis. So I think for on business combination is a very, very important standard from an accounting perspective, which has got a lot of complications, but also that standard really brings out a lot of changes in the way a company is currently operating, the environment is operating, because a lot of things would come onto the books of the company, and there could be a lot of issues which would come either in terms of taxation, in terms of the way companies accounting for employee cost, there could be ESOP implications, there could be policy changes, there could be IT changes, and that could really change the culture of the company in one way. So this is a very important standard where there are a lot of estimates involved, and one really needs to focus on the risk element of it, and also see what control measures the company has in play, and play a very partnership role with the management. The third topic on the same estimates I would describe upon is on impairment. Now, impairment is typically a one-off event. When we talk about impairment here, it is more on impairment of, I would keep it simple, impairment of fixed assets or a CGU as we call. So the question is really is that when one has to really look at impairment, is it that company has to look at it every year, or the company needs to look at it on a periodic basis, right? So that is the first critical question one needs to go through. In case, of course, you'll be aware that in case the company has a goodwill on the books or any other long-lived intangibles, typically the goodwill is tested for impairment on a yearly basis, right? And therefore, there definitely will be some processes the company will have, and there will be some control surrounding that which one can test. But if you just leave it apart for a minute, which we'll come to, if there is no goodwill, and the bigger challenge every company would face is that when they should test impairment, and therefore there has to be a good process surrounding it, and also a good control framework surrounding it. What are all the trigger points, either it be internal or external, which one essentially needs to look for, and the management needs to assess for it. For example, COVID is a good trigger point which everybody can easily relate to, right? That yes, there is a downward trend of business, and therefore that could be a potential impairment which one could test upon. But all situations are not equal to COVID, right? So there could be some ups and downs, sector specific, business specific, etc. And therefore one needs to really look upon the impact the business is going through, and therefore put across controls in place. Coming back to a normal impairment measure in terms of identification through a goodwill mechanism or otherwise, what one really needs to look for is essentially two things. I would keep it simple and not get into standards more, but from an audit perspective, typically an impairment is measured using a DCF method in a very generic way. So what I mean by DCF method is that the company prepares typically a projection for the next 4 to 5 years, and then has a methodology to say that the business would grow in a particular way, the cost would grow in a particular way, and therefore the value of the business on a discounted basis is X. And that amount essentially is compared to the CGU, and then weighed upon to see if there is a impairment provision or not. So in this methodology, there has to be a lot of controls in place. The first control in place the company should essentially have is a control towards their own business reporting, their own segment reporting, their internal MIS reports, because this is not for the full company, this is for a particular CGU. And therefore, how is a CGU's business carved out separately and identified as one key thing, right? So there has to be control surrounding that, which one needs to really focus and test upon. The second topic would essentially be in terms of the inputs which go into the model. Okay, there are various assumptions which go after day one. The first year comes through based on historical data. Now there has to be assumptions in terms of future growth, projections, cost projections, revenue projections, etc. There would be budgets placed with the board. How does it tally and marry with the budgets? And if there are numbers beyond our budgets, what estimates company is using, and what reporting framework the company is essentially using to ensure that these controls operate the right way and there are proper reviews which happen. Sometimes the company uses a third party or an expert to get these valuations done. Sometimes they're done in-house also. Whichever methodology is being followed, as an audit function, one needs to really challenge those assumptions the company is using, assumptions in terms of growth, in terms of forecast, in terms of method, and then see how they are backworking in the context of impairment. So maybe in case time permits, we will talk about MRC controls as well towards the end. But these are typical controls which are very estimate driven, and one needs to really focus upon to ensure that management does it properly, because a small change in the estimate and a control lapse could lead to a huge issue in the balance sheet of the company. And as auditors, as a function, everybody becomes responsible for it along with the management. So I would possibly pause here and hand it over back to Prasanna to cover a couple of few topics, and then I'll come back. Thank you.
I think as Raghu mentioned, 3 areas which are one-off in a sense, but a very relevant areas in terms of involving key judgments and estimates. What we will do maybe over the course of the next few minutes is look upon something which maybe I think we have all as professionals seen and gone through, say something like an inventory. Now, from an internal audit perspective, and maybe just taking a step back, the way the inventory accounting and the way the inventory valuation, etc., gets done in entities have evolved drastically over a period of time, particularly with the advent of ERPs, with the advent of multiple applications and methodologies, and the way the products, etc., have also got say built in entities. This itself has drastically undergone a change. What therefore I think becomes more important is, I'll put it in an area such as inventory, is to just go back to some of those basics to get those things right, because as an internal audit team, naturally, depending on the entity, depending on what the entity's priorities are, the focus could be on, say, something like a costing, something like a price discovery, something like a cost saving avenues, and how things are worked on some of those areas based on the business priorities. But then what is also equally relevant over a period of time and at maybe at a rotation, etc., is to look at how things as simple as a physical verification process works, including at, say, a third-party location for a particular company. Is that something which is happening in a robust way? Do carry out those surprise checks to see is that something which is throwing an aberration, which then could potentially impact the way the inventories get recorded and therefore get reflected in the financial statements. What also happens very often is the companies have a control and have a mechanism of a monthly inventory count. But more often than not, there is also a tendency to say all these adjustments will get posted maybe one fine day over a period of a year, etc. Now, that then poses its own challenges also, because it then catches up over a period of time. Now, look at whether all these entries, adjustments gets recorded on a timely basis. Invariably, there are sub-ledgers that each of these inventory modules have, is the reconciliation and the interface between the subledgers and the general ledger seamless? Is there something which is unreconciled over there? Controls over the inventory master, who can make a change, the BOM updation, who has access to access to the BOMs, who has access to make a change in the BOM, because each of this typically then comes back to the way the cost gets recorded, particularly with the current way of inventory valuation, where the visibility to the way the inventory gets computed, the value gets computed, or the COGS get computed is not so straightforward. I think there is we do couple of steps in an SAP and an Oracle. An entry comes, but then how much is that something which is accurate, correct, is not something which so visible. Therefore, one of the steps also is to take an example and see how the cost itself gets considered in the context of inventory valuation. Is it something which is accurately being reflected in the financial system? Is it coming out the way it is supposed to come? Where companies follow standards, how often does these standards get reset? What comes and gets accounted as variances? Is that being analyzed and appropriately considered from an inventory perspective? Typically, there are also situations where there are manual adjustments that companies have, and how we look at that. Now, as I mentioned, I think internal audit as a function need not get into each and every element of a financial reporting angle, but once in a while, maybe on a rotation basis, these are some core areas that will really play a big role in making sure that the integral design of a particular control and a core activity of an entity, it's actually working the way it's supposed to work, because and it very often is not something which is very visible in the overall context. Purely from a accounting angle, again, there are items like how to make an assessment of a net realizable value. It could become very complicated where the nature of inventories are such that the prices are entirely market driven. It's very competitive. There are companies who come up with say discount schemes, incentives to liquidate the inventory. Now, in those situations, how someone actually gets the net realizable value computed, is there enough mechanism to capture all of those, becomes very, very relevant in the overall scheme of things for a particular say an internal audit team to look at, because then poses its own challenges, and more often than not, while there is enough focus that we definitely get to see in terms of the pricing, the recovery for price revisions, the say the cost savings, etc. Some of these core reconciliations, the core checks, and the controls that any of the companies would have designed, the focus on that could also throw and actually go a long way in getting some of these things done. And what is also happening, just to spend a minute more on this topic, is as part of the regulators, say for example in the new CARO that has come in the current year, from 2021-22 onwards, auditors are required to report on the company's filings of inventory records, statement of debtors, etc. with banks on a quarterly basis, and are there differences? And it will be surprising to note that there were many situations where both were not talking to each other on a direct basis. The inventory ledger gave a number. The team which submitted to the banks went ahead and just sent the inventory report. What is there in the financial statements and the trial balance showed a different number, typically because of items like manual adjustments, interface issues, say entries that were recorded directly in the trial balance, which never gets regularized in the ERP. Now, these are some fundamental lacunas because while it was year one of reporting, it also now has a bearing from a external reporting angle. Not that it was not otherwise relevant. It was always a scheme of things which we as auditors used to test in the traditional world. But with things that have changed over a period of time, I think it's important we go back to the basics on some of these, particularly items like inventory, and we thought it will be relevant for us to spend a few minutes. I'll not get into the details of what is covered here as, say, I think, for example, how to test the product cost in terms of a particular item. Now, it's not something which many companies actually do. You go and ask a finance controller today. All that they will tell is, I go to this module in SAP, I go to this module in ERP, I choose X report, I then do a posting, then I get a result. Now, that's fine, but what comes out, what goes into that particular module, what exactly the system does, and what comes out is naturally subject to enough, testing as well as understanding from a finance perspective. And therefore, I think from a typical product cost evaluation perspective, a control involves us to just go ahead and confirm what are the inputs that a particular control owner actually uses. If we were to recalculate, reperform that activity, are we coming to a conclusion which is, say, matching, which is different? If different, what is the extent of variation? Is it within the threshold, above the threshold? Now, these are elements which are very, very important and could actually go a long way in setting, maybe re-looking at the way the system was configured. Because, say, when the ERPs were implemented, there could have been a particular way in which it was designed. Things have evolved. We have the volumes have picked up. I think it's important these gets relooked at a particular point in time or over a period of time, because there will be enough surprises which comes along the way, and something as core as an area of inventory. Moving to another example of, say, an area which we thought will be very relevant in the current scheme of accounting that's being followed, is for accounting for leases. The new lease standard, which came in a couple of years back onwards, has given a rather new dimension to the way the leases got accounted in the books of the entity, and therefore, what that has also resulted in is to make sure that the company has enough checks and balances, enough mechanisms first to capture the data in the way the standard requirement is designed, and to comply with the requirements of the standard. Now, just to very quickly brush the memory in terms of what the standard itself entails, it basically where it meets where there is an identified asset as defined in the standard, and it meets the definition of a lease. It requires that the right of use asset for that lease gets recognized in the balance sheet. And the way it is getting determined is also it's dependent on the amount of lease payment that the company has to make over a period of the lease term. Now, what a lease term is could be subject to its own interpretations in terms of, say, a primary lease period, an option to extend, an option to terminate, who has those options, whether the lessee has or the lessor has, and each of those could play a role in terms of what the lease term or the enforceable period is from a standard perspective. That lease period, if it is naturally for most of these leases, it will be long-term leases which gets recognized. Therefore, there is an element of discounting that comes in. The standard specifies how a discount rate has to be arrived at. That has its own uniqueness in terms of getting that right, having enough documentation to get that rate appropriate, and it does have its own disclosures. Now, what then this means is to have those controls that gets built to ensure that the reporting requirements on these lease gets fulfilled. Because at the end of the day, if it was never in my balance sheet, what was paid as a lease rental was what was getting charged to my statement of P&L. Of course, there was an element of straightening that was involved even in the earlier gap. Now, in the current gap, current Ind AS standards, it is there in the balance sheet of the entity. In many companies, it's actually a huge number. So the first and foremost is to have what is the control over the lease database that the company has. Is it something which is capturing all leases in the first place? Having captured, is it also then looking at what constitutes a lease? Because that itself is not so straightforward. It again brings in elements of what an asset is and how those gets captured. So that then requires an evaluation and a thought process to be put in. It then goes back to how robust those are getting documented in an entity. The contract terms, the more robust the database is, the more easier or rather efficient is going to be the accounting process, very frankly, because the number of leases could just be numerous. Each contracts could have its own uniqueness, and therefore capturing the contract terms in a particular manner is very, very important. And I'll just spend a couple of minutes in the next page to typically say how an input control in a contract database actually looks like. There are elements within lease where, say, in many of the lease contracts, there is an element of lease for the asset, which is, say, an IT park, for example. You take a lease of a building, you pay rent for the building. There is an embedded element which many times doesn't get separately carved out, which includes a periodic maintenance fee. The question then is that a lease component? Is there a non-lease component which is embedded within it? How that gets allocated? And is there a manner in which that gets split? Discount rate, I spoke upon that. Lease term could be a very, very judgmental area, given the type of contracts that could get entered into. There will be options for both the lessor and the lessee to extend a particular contract, to terminate a contract at their will and wish, at times with prior approvals. Each of this could have an accounting implication in terms of what the period is, because a period here determines what is the amount of the asset and liability could potentially come into our balance sheets. And therefore, that's a very, very relevant determination to do at the inception of the lease, including, say, an element. When it comes to things like termination, the extent of investment, the importance of that particular asset to the business, all that becomes a factor. How people record entries for lease itself is a very interesting topic, if I were to just put it that way, because this has got nothing to do directly with the amount of lease payments that a company does. So therefore, what invariably still today companies follow is to say, okay, this Ind AS adjustment for this right of use asset is something which I will keep separate. The periodic lease payments continues to be recorded the way it gets recorded. So the sequence of entries that one needs to look at for getting the lease accounting right itself requires a good amount of controls and review to be done. Many companies where the lease is quite sizable have also used, or rather opted for, IT applications to compute the lease module. Many ERPs themselves offer the lease accounting module, the real estate module, which factors in this accounting. The controls over that IT application, the access controls, the general IT controls, and the database and security, all the more becomes important. So this as a standard which has posed its own challenges of late, and typical steps, including in the say lease contract database. I think while as much as each of this looks very, very simple or straightforward, I think in experience, what we have all seen is absence of even one or two of these data in your master or in your database takes months and months for companies to actually then put that across. So getting that in place in the first place and making sure that that operates on a regular basis in a very sustained manner is therefore very important. And typical things would include the name of the lessee, the asset under lease, the location ID, map that location ID to what is there in our fixed assets register as a location ID. I think who are the persons who executed to the contract, what is the security deposit, because that then has its own accounting impact. We spoke on the contract terms. Is the criteria itself getting met? What is the escalation period, etc.? Because each of this then has a bearing in terms of the amounts that get accounted. So here again, and because it's there as a significant number in the balance sheet, while from an accounting angle, it's there as an asset, it's there as a liability. A part of it goes into a depreciation. It comes into a finance cost. It does have an impact in terms of the way the EBITDA, etc., gets evaluated for entities. Therefore, it's something which is of importance to the management as well. There again, internal audit as a function could play a role where these controls and checks and balances is something which could go a long way in getting it right, because the headache of not having this right is it just consumes a lot of time and for something which appears to be rather straightforward. So that's something which on the lease contract itself. We're just left with maybe a couple of topics, and I'll request Raghu to touch upon another important topic in the context of related parties, which has gained enough traction in the recent period. Over to you, Raghu.
Thanks, Prasanna. Okay. Related party is a very controversial topic, I would say now, given that everybody is focused on this. And the related party is one topic which has been touched upon by everybody. So you see a definition of related party under the textual Indian GAAP. There is a definition of related party under standard in Ind AS. There is also a definition of related party and Transaction Companies Act. We also see references of related party in SEBI, LODR. There's also a definition of related party and transactions at arm's length under Income Tax Act. So whichever regulation one really touches upon, related party is a very well spoken topic now, given the relevance and importance of this, because to some extent very judgmental, and a lot of misuse has happened in terms of fund diversions, etc., over the past few years in this topic. So one has to really be focused upon on this topic. And the most critical part in getting this done, and the challenge which the management also is facing, therefore the internal audit team will also face, and the other stakeholders like board and audit committee, is to ensure completeness of it. When I mean completeness not only in the context of the transaction, but completeness even in terms of identifying the entire list of related parties. Many situations where there are large conglomerates involved, transactions being entered into by subsidiary companies, associates, etc., also come into purview of approval by the holding company, which we will talk through due to a new LODR amendment effective April. But the web is just becoming bigger and bigger, and therefore the company really needs to have a very robust mechanism to ensure and identify all related party transactions and the parties itself, first of all. And once the parties are identified, the next important step is on transactions. This is where the entire issue comes upon, and I would bifurcate the transactions into two broader aspects. One, which is a routine purchase and sale transaction the company generally enters into. The other kind of transactions are transactions in terms of royalty payment, in terms of service arrangement, management fees, IT utilization, etc., where it becomes very, very judgmental in terms of determining the fair value. So on the first part, which is essentially a material transfer, the company, first of all, needs to have a very robust mechanism to ensure that the transactions are at arm's length and they are essentially compared with competitive quotes, either on the purchase side or on the sales side, to ensure that they are able to demonstrate either through a transfer pricing mechanism, a third-party study, or in-house, whichever method it could be, to ensure that those transactions are at arm's length. And many of these transactions now require prior approval of audit committee and board as well. So many of these transactions cannot be undertaken by the company, and we have seen in our own experience that since the company is huge and voluminous, while the finance team may want to ensure to comply upon this provision, there could be a procurement guy just entering a transaction which nobody would be aware of. So how essentially the entire ecosystem in terms of either procurement function, a sales function, even admin function, everybody is well aware of the requirements, and if they are going to transact with these parties, what control and mechanisms a company should have in place. It all depends on company to company, but I'm not generalizing that they should have a particular method, but this is very important. And once you go back in your own companies and see as to what all those processes one should keep in place to ensure that all stakeholders, all functions are made aware of the regulatory requirement and therefore ensure that they follow the adequate process, which includes in many situations board approvals as well, right? So next, when you look at sensitive transactions, which is transactions in nature of services, management fees, cross-charge mechanisms, IT related services, royalty related services, right? Many of these transactions may not have essentially a equivalent or a easily determinable benchmark. So how does one go about ensuring that the company has ensured arm's length or the transaction is fair with the other party? How the auditor, which is the internal audit function, is therefore able to challenge the management is very, very critical. And therefore, one needs to really ensure that the company gets the relevant backup from the, for example, a parent company abroad or a group company within India, or they need to essentially look upon to have those conversations ahead of time with the respective process owners to ensure and understand the methodology in which these are computed. Otherwise, there could be challenges the company could face, either from SEBI if it's listed, or from income tax, or from Companies with Companies Act, etc. And therefore, this is a very focused area from an internal audit function. Also, I would say that one as an ongoing activity throughout the year, and also on a periodical basis to ensure that the compliances are tagged upon. Now, there have been a lot of amendments which has come, which also places responsibility on, say, holding company to ensure that related party transactions of the subsidiary are also being approved by the holding company's board. And therefore, the onus is quite high with respect to a company, and therefore equally the onus becomes very high with respect to the internal audit function. So this needs to be looked upon well ahead of time, and the mechanism and the processes the company is placing needs to be verified. The best way we have seen many companies do it effectively in the internal audit function is to create a comprehensive checklist. A checklist which essentially would first capture all the relevant provisions of the law, a checklist which would capture all the relevant matters which a person needs to essentially follow before, say, a particular PO is approved, before, say, a particular sales order is approved. And this checklist can either be a manual checklist or it can be automated through a workflow. If the company is able to get this, and therefore the function is able to test all of these mechanisms in play, there will be a very seamless approach between the management and the audit function to ensure compliance. For some reasons, if they are more manual than automated, then one has to really understand as to how the company is maintaining these records more on a I would say a timely basis, or even well ahead of time before such transactions happen. The biggest challenge which audit committees and boards are currently facing is to get them to get to a conclusion that they are at arm's length and they are not onerous to the nature of the transaction. The purpose and benefit should be very clearly defined as well. So when one has to define all of this into parameter, therefore there will be a lot of reliance which we have seen audit companies and board requesting internal audit functions to ensure and give them a comfort, or statutory auditors to do that comfort, or even a third party consultant to look through all of these transactions so that the board can approve those transactions, because the board otherwise will not be able to get to a right conclusion whether these transactions entered into by the company are appropriate. And therefore, the function, I would say, the internal audit function can play a very pivotal role in this topic in terms of ensuring proactively to identify transactions, ensure the company has processes in place to ensure all of these are met, and also married upon with various functions. What I mean by various functions is that sometimes the company files its returns in Form 3CB for transfer pricing. There it cannot be a different play or a stand. The play or a stand the company is taking in a Form 3CB has to be consistent in the way the company is approaching when the transaction is being approved commercially with respect to, say, Companies Act. And that cannot be well different from what a company is going to disclose in the financial statements when they do RPD transactions, right? And they cannot be well different from what they write in a say a Form 3C under 48(2)(b). So lot of places the government has now got checks and balances to get these data points, and therefore the company needs to essentially have a mechanism where all of this is looped and everything is in a seamless way to ensure that the transactions flow in a very rational. The business will definitely have a rationale as to why they are doing a particular transaction in a particular way. Those need to be documented well, and it is for the control owners to check whether the rationale is documented well, and for the internal audit function to ensure that they are done on, I would say, a timely basis, and also in a very periodic basis, and not towards the end in terms of approval being retro rather than being prospective. So I think that is one thing which we thought is very, very critical in the current context from an accounting standard, but really having a larger play in the entire scheme of things from an audit function. Over to you, Prasanna.
Yeah, sure. Thank you. What we will do, I think, is we just have this is possibly the last of the topics from an accounting and accounting standard angle that we wanted to touch upon. I think we just have about 20 minutes or so. In the interest of time, while I will try and wrap this up and conclude in the next few minutes, people who have questions, you can maybe put it in the chat box so that we can take that as well as and when we complete this session. Financial reporting and close process, we thought is again a relevant area, which is very, very important in the context of the topic that we are talking today, say accounting standards and internal audit, and where internal audit can actually play a significant role. The topic by itself entails a wide gamut of things, be it from the way the accounting policies get chosen, evolved by the companies, the overall function of the finance team, the way the journal entries, etc., gets recorded, the way the financial statements get prepared, and it just, as I said, is a whole gamut of financial reporting, including internal reporting, be it in the process of a business plan, a business review, or controls itself. Now, what we thought, rather than getting into all of those in a greater detail, we'll take an example to say what possibly are the areas which is very relevant even in this context of things, and from an accounting angle. Many companies today have a wide range of group entities, therefore consolidation is a mandatory requirement under the Companies Act, even for unlisted companies today, subject to certain exceptions. What then becomes very important when we prepare consolidated financial statements is to have enough controls and a review of those controls by a completely objective and independent team, such as the internal audit team, to ensure few things. Now, it could be as simple as are we getting all the right entities consolidated in a group structure where there are multiple group entities? this itself becomes a very relevant topic, and also because of the fact that the accounting standards as they have evolved of late doesn't only give relevance or importance to the shareholding percentage that a company has. It brings in concept of control, it brings in concept of significant influence, and each of those could also be in situations where a company doesn't have a majority shareholding, a company doesn't even have a 20% shareholding. So therefore, it's important that the overall group structure, there is enough mechanism to review that. That gets revisited periodically with additions during the period, with deletions during the period, and that's a very important aspect. What is the extent of assessment of, say, whether there is control, for example, I think over a subsidiary? And for that matter, while I spoke about the shareholding, there could also be a situation where there is shareholding, but we could result in a situation where there is no control or there is no significant influence, though it has to go through a very detailed assessment and documentation of the key construct of the arrangement and the judgment behind that. So therefore, that becomes a very important assessment. More often than not, what typically happens is because many of these financial reporting and close process comes towards the time where there is a board meeting, there is a deadline. These topics as such maybe tends to, I'll not call it least importance, but in the interest of time, it just gets it doesn't get enough attention, I'll put it that way. And that's really where I believe an independent function such as an internal audit team, if they start looking at it, there will be a timely review of some of these key elements that then comes in, because there are also elements like, say, a consolidation package. How does that interface work? How does each of this actually talk to each other? Are there entries which sit within at a consolidated level, but it actually relates to a particular business unit or a particular subsidiary, but the entry gets taken only at a consolidated level? Is that fine? It could all have a bearing in terms of the way the transfer price gets fixed for each of these entities. Overseas subsidiaries, the gap itself could be different. The accounting gap, the policy choices needs to be evaluated. Adjustments would need to be carried out. The way these entities get converted could have its own challenges, particularly, for example, today, with the way the entities in, say, for example, Sri Lanka. So the way the economy has been moving there, if you just look at the way the exchange rates have moved, it just gives a very odd number. But each of this requires an evaluation, an accounting evaluation, and appropriate way in which this gets dealt with in the financial statement itself. And that's something which is very relevant, and that's an area where I think an internal audit function could play a role, because one thing is definitely happening for sure in the financial reporting world. The importance that the consolidated financial statements gets has been on the rise, particularly in India. And that's something which is all the more relevant given the way the business models have also evolved. In particular industries, there are enough SPVs that a company has, which then caters to a particular project. Now, if I have 25 SPVs, consolidation is going to pose its own challenges. We then need to make sure that there are enough checks and review mechanisms that are there in place. One important element, while this is relevant not just in the context of consolidation or financial statement preparation, but even in the larger other key estimates, including things like ECL and all that, is the use of spreadsheets is also extensive. There are still many companies who prepare financial statements in Excel. All of us are familiar with how Excel is, but it's also important we know what the downside of the Excel is, and therefore the review of the mechanism or the governance mechanism a company has in place to monitor the way spreadsheets are used in a particular company is also important. And this is an area where actually an internal audit team can play a big role, because it may not, while this is an example of consolidation or financial statement we are talking about, this could be true for various other business reports that the company prepares. It could run into pages and pages and rows and columns, and a small error in one particular column or row could swing the results extensively. So there are companies who are looking at they actually have a spreadsheet governance team or a committee which only looks at how people go about using Excel sheets. How people, is there a user access monitoring for it? Is there a way the versions get controlled or tracked? Basically, who has a mechanism to edit something over there? Very often there are, even writing a macro today is something which is on the web. There are people who in their own interest do that, but then all that then also means that a check on the formulas and the way the things get computed is very, very relevant. And that's something which we will need to look at in a bit more detail and closely as well. So to that extent, I think this will be another relevant topic which we will need to look at in the overall context. I think we touched upon this. We will not spend too much time on things like management review controls. I think Raghu spoke extensively on the estimates, the impairment and all that. To sum it up, I think this is a very subjective area and can be done by people with enough experience, and therefore the outside in view from an internal audit function, which is an independent objective function, could go a long way in getting the finance control team getting those results right. So with that, I'll just hand over to Raghu to share a few concluding thoughts before maybe we can just quickly scan through some of the questions that are there in the chat box. Raghu.
Yeah, I would keep it simple, and maybe we'll have more questions from a chat to discuss upon. Therefore, I think the session, which is actually entailing the financial accounting standards and the internal audit, is very, very relevant in the current context, given that a lot of changes are happening in this space, and therefore a lot of focus is being brought upon by regulatory front, and a lot of issues are happening with respect to the environment which one is actually going through in terms of either a fraud risk environment we are facing, or a cyber attack situation which many companies are facing. So all of these really bring a larger and greater focus in the way the audit functions needs to really be focusing upon, and also see how we can use technology as a forefront mechanism to ensure that many of these are addressed upon such voluminous transactions the companies are built. The most important thing is also to build the relevant skill set within each functions. So the audit function should therefore have a right mix and balance of skills which understands business, skills which understands technology, skills which understand the regulatory framework in which we are operating, and also the skill set which are required to ensure that the entire governance process in place. So therefore, what I would conclude by here saying that is that while we touched upon various topics, which includes revenues, estimates on various topics, we spoke on leases, related party transactions, they are just few topics which are from the standards which we tried linking up to the function which we do on a daily basis. And therefore, there are quite a lot of things, and one really weaves all of this into the function. As I said in the beginning, the internal audit has got a huge gamut of things to cover, and therefore it is very voluminous for the function to really ensure that the company is kept on toes and doing the right things. And therefore, there's a huge responsibility on the entire function, and I'm sure we will hold the company high. With this, thanks a lot for the opportunity given to us, and hope the sessions were relevant and interesting to all of you.
Thank you, sir. Thank you, Prasanna, sir. Thank you, Raghuram, sir. So now I request Ravi, sir, and Mr. Paul Jaker to give the closing note. So we have few questions in our chat box.
Can you read the questions, Anup?
Yes, sir. This question is from Niladri Bhushan Senapati. There will be a conflict of interest with internal stakeholders, like who has done with WACC assumptions.
Okay, so that maybe I'll take it up. That's on the WACC assumptions, which are essentially used in impairment. I would just presume, Niladri, you're talking about that. Yes, there will be definitely conflict of interest with the internal stakeholders. The management would want to take the most optimistic and the rate, which is, I would, for lack of words, say convenient to them. That is where the entire function of the independent internal audit team comes into play, is to challenge them to see whether the assessments and estimates done by them is right or not. In many situations where the stakes are very high, typically one really also falls upon and takes comfort from external consultants, where they also go for an independent evaluation report, and that valuation reports would also throw up rates. And with the combined assessment with all of this, I think the ultimate goal of getting to the right answer would be achieved. More critical point here is to ensure that the processes followed by the company and the review mechanisms in place are so good that such conflicts of interest will not happen, and the responsibility is cast on the right relevant person. Therefore, the decisions taken by the persons are actually appropriate, rather than trying to go back and question and change them.
So next question is, with many companies outsourcing the IA activities, is there a need to also have IA staffs with the organization?
Maybe Anup, I think we can share with practical experience. Yes, I think there are entities who have the entire IT function completely outsourced. What we have also seen, which works well depending on the nature of the entities, is a mix of both. Say an internal audit team led by an internal person who has been there in the function, in the operations, who knows in and out of the entity. On select topics, they then outsource depending on the requirement. So I think it's a question which depends on the nature of the entity. I think a mix of both these models is also something which has worked well in many entities actually.
Yeah. So just add on to what Prasanna is saying, while many companies are outsourcing, my personal view is that every company also needs to parallelly develop their own skill set in this topic, and therefore they need to definitely have their own team. While the team can take some help of specialists, either it could be on digital, it could be on forensic, it could be different things. But in-house team which really understands the business well, with a good flavor of an external third-party eye and view, would be the best combination to have.
Thank you, sir. And next question is, how relevant are digital audits today? Will financial reporting become online and put more pressure on auditors?
Okay, so digital audits are already on way, I would say. Many of the companies are using technology to ensure that things are checked as and when the transaction happens. And as auditors also, they are using a lot of technology tools to ensure that it is no more the routine 25 samples or so to be tested upon. The boards and audit committees are requesting for comforts far beyond of that in terms of the entire population, and therefore digital audit is definitely there. I won't say we have reached to what we should be. I think it is a path and a journey, and therefore there would be situations where it would definitely put tremendous pressures on the statutory and the internal audit function. And I think that's a part of the game. We should play it out.
Thank you, sir. And next question is more the standards, how technology audit standards will become relevant.
Prasanna, you want to take it?
To extend what Raghu was mentioning, I think this is going to come. It's a question of time when all these are going to be more relevant. Even as we speak, I think the audit of the technology, the applications that gets used in a particular entity, including security surrounding this cyber environment is something which gets tested by the auditors, but it's going to become the order of the day as we move ahead in maybe a few years' time. Actually, I don't think that day is very far off, frankly.
Thank you, sir. So next question is related party transaction. How do auditors take control in ever-changing scenarios and promoter-driven companies?
Yeah, it is of course a challenge in terms of the current situation where there are a lot of dynamics involved. One in a promoter-driven company, or also be even without promoter-driven companies in terms of far voluminous transactions and stuff like that. The only way this could essentially happen in the right way is a strong finance function. First of all, the finance function needs to be fully aware of their responsibilities. The board also needs to, in some situations, take the responsibility to some extent if there are independent directors. And if there are no independent directors, it falls back on the finance function. And if the tone at the top is very clear in terms of how they would want to structure the organization and grow, the inter-audit function typically gets a direct line of support and reporting to the board, and therefore giving them that, I would say, extra power and mileage to really look at through these transactions and report if they find any things which are not in normal course. And therefore, such function should use that diligently and flag off transactions which they believe are not taken in the right way. And a process, if it is set in that particular manner, would really help all the stakeholders to get to the right conclusion towards the end. Prasanna, any thoughts from your end?
Regulatorily, the internal auditors have been given powers to even report transactions directly to, say, the central government. Now, I'm just saying it's a question of how, as a professional community, we also look at some of these things and bring in that importance, because and there are entities, by the way, who take internal audit so seriously. A high remark in an internal audit report goes against the entity. So it's a question of how that importance is driven at the entity level. And I'm sure over a period, I think it's going to settle down for entities. Maybe Anup, in the interest of time, I'll just take quickly the next question on how relevant data reviews are to accounting standards. I think it's a very, very relevant topic, and we spoke of enough examples today. The sanctity and the accuracy of the data is going to be the key. With more and more technology coming in, with more and more availability of data, also with more and more, as Raghu mentioned, departments are now talking to each other. There are multiple reportings which companies do. Just as companies use technology, governments are using technology. They are linking what you file for a GST with what is there in your accounts, what is there with your income tax, etc. Therefore, the correctness of the data is of paramount importance. So therefore, the importance to the master controls, the exceptions to the masters, a KYC compliance for that matter, is the registration number of a particular vendor correct? Now, how robust is that review mechanism? Each of those are definitely relevant, and that's going to be increasing in context as well as the internal audit function and the overall relevance itself goes. Okay, maybe Raghu, you want to take this? How do we mix regulation, accounting standards, and ICFR control and CAR reports?
Okay, so yeah, everything has to be looked at it together, either accounting standard or ICOFR report or CARO. In CARO, I think from an internal audit function, there is a requirement the statutory auditor has to comment whether the internal audit system is adequate, it's commensurate to the size and the level of the business company is having, and therefore the onus is also on a statutory auditor to comment upon as to how the internal audit functions. There, the ICOFR also plays a very good role, because ICOFR is something, a risk control matrix system on each processes a company has to really put in place, and it has to be first agreed upon and understood and also checked upon by the management and also by the internal audit team. and then by statutory auditor. So there's a good amount of layering involved in terms of checking the ICOFR controls, and doing that control mechanism, one really gets to a conclusion whether the internal audit system is adequate, etc. And therefore, the accounting standard, I would say, is well woven into the internal audit process, because internal audit as a process is an audit of a process of a particular transaction, right? Either a revenue process or procurement process. And these processes needs to follow a particular framework. And the framework would include law of the land, which includes various acts which is in place, and also, of course, accounting standards. So all of that put together becomes the framework under which an ICOFR is really tested upon. And ultimately, it is commented upon by the auditors in the CARO and the ICOFR report. I think so that is a good integration mix which is coming through. But sometimes I personally believe it's too much of overload of things happening in terms of reporting and various clauses, etc. They removed the CARO clause, brought it back, etc. But having regulators have their own views, but we just have to follow what they say. But I think if you remove the pain points associated with reporting, etc., in the long run, it is good, because they're also forcing companies to bring to high level of compliance and governances, and therefore very interesting for organizations to really uplift from where they are to where they want to really achieve. Any other questions? Sorry, I'm not able to read the Q&A.
Your response feeds in well to the maybe the last question, Raghu, on where does audit end and investigation begins. If I may just add that, I think with multiple reporting requirements today, and each regulator, each stakeholder looking at things in a very different way, I think the boundary between each of this is becoming thinner by the day. But I think that's really where the importance of, say, a governance oriented organization comes in, because I don't think an entity which is focused on governance, which has a good governance mechanism, needs an auditor or a statutory auditor and an internal auditor to come and tell where something requires an investigation. I think that process by itself will take care of that. Now, if the entity is of such nature where an auditor has to go and have those discussions, yes, the boundary is going to be a bit of a thin, but I think that's really where the professional community also has to focus on governance, bring in enough internal controls, importance to these to be driven through managements. And the moment it becomes ingrained in an entity, I think it will be a very easier discussion to have rather than having this as a separate topic. Yeah, I think pretty much. Anup, any other questions?
No, sir, we have covered most of the questions.
Okay.
So, yeah, thanks for the insightful and interesting session, sir, Prasanna sir and Raghuram sir, taking our time. So I'll request Paul Jaker sir and Ravi sir for the closing notes.
Sure. Thank you so much.
Sir, we'll take the opportunity on behalf of IIA Madras chapter in thanking Mr. Raghuram and Mr. Prasanna for making a very complex topic very simple. We thank you for the elaborate examples and the time you've taken to prepare the PowerPoints. And I know a lot of work has gone in there. So a lot of research has been, I mean, your practical knowledge has been researched and put into a very compact session. We thank you, sir, because that's both of you. It's a very elaborate session, sir, very compressed, very nicely done. And I would like to thank Mr. Ravi Veeraraghavan, who's taken, he's a Chennai chapter president, who's taken a lot of trouble to organize a lot of these meetings. Instead of just one a month, we are having almost every week. I want to thank Anup and the entire coordination team, technical team, and I want to thank all the participants. Thank you, sir, once again, both of you, sir, Mr. Raghuram and Mr. Prasanna, for this excellent presentation, sir. Thank you very much on behalf of the IIA Madras chapter. Sir, Ravi, sir, would you like to continue, sir?
Yeah, thanks, Raghu and Prasanna for the excellent presentation. It's a very relevant topic today because whenever I go for internal audits, the standards seem to be one hanging around, but it's become very critical from a regulatory perspective. The standards only help us protect ourselves from our work and also from the regulators. So thanks once again. And thanks, participants. You'll have the recording shared with you once it is up tomorrow. Get the recording shortly. Thanks once again, and have a great day. And the next
Thank you,
session
sir.
is on November 9th, which is the risk and management. And Raghu, any final thoughts? Raghu and Prasanna, thanks again for the time.
I think thanks a lot for the opportunity. Wonderful time talking with all of you, and good, very insightful, good questions as well. Looking forward, and thank you so much.
And very nice interacting with all of you. Thanks a lot. Have a good night. Thank you.
Thank you, sir. Thank you so much for your time. Thank you, sir.
Thank you. Bye-bye.